personally, I think we're going to start seeing a lot of volatility going forward.
Oh, why is that?
Well, based on what Janet Yellen said about the economy being stronger, and next Friday is the big jobs report, and that's going to be a huge number for the Fed as to whether this interest rate happens sooner instead of later. And, the Wall Street's bet is December, but there is a chance it could be September based on this numbers next week. So no matter what, I just feel that we're going to start seeing volatility. The market's going to have big up days, big down days, because no one's really sure what's going to happen.
Is the volatility a product of the unknown until the interest rates actually rise, or is it that the interest rates rise and the volatility starts? What's the chicken? Which one's the chicken? Which one's the egg?
It's a little bit of both. I mean, obviously, if we don't know where interest rates are going to go or when they're going to be increased, that's going to add some volatility in that people may be taking some money off the tables. Especially, the shorter-term traders, some of the hedge funds start selling. They've made nice profits. Maybe start looking into other things or ways just to, take risk off the table. And then, as I've been saying, as interest rates start to increase, bond yields will go up, which means you'll start having people slowly slide from stocks back to bonds so they can get their yield with less risk. When the interest rates do rise even higher to a normalized rate, that's when we could really see problems in the market, because all of these high dividend paying stocks that have been running the past 3 years, they won't be as attractive because, one, if I can get 2.5% risk-free and a bond, relatively risk-free, compared to 2.5% in a stock, which I don't know where the price is going to be, I'm going to take the bond. And so we'll see a sell-off in stocks at that point.
How much could the sell-off be?
I always use an analogy of you stretch a rubber band, the further you stretch it, the harder it snaps back. Well, this is the second longest bull market in the history of the market. And if you look at earnings, it's not like the economy is going gangbusters. It's not bad, but a lot of people say it's not great. So we're stretching that rubber band really far. And what we've seen over the past 2 years is that markets overreact no matter which direction they go. And a lot of it has to do with computerized trading. You get a lot more fast-moving trading, and it pushes the market up faster than it should and down. So a real correction, I wouldn't be surprised to see 25, 30%. I'm not saying when, I don't know when. But when we do get a true market sell-off and correction, I expect it to be worse than we think, just based on what we've seen the past bunch of years with market overreactions.
That's really interesting. 25, 30%, that's a lot for people to there. So what would you tell investors to start thinking about as they're looking at, your services or others at this point?
Well, right now we're still in an uptrend, so there's still no reason to, try to jump ahead of it because you can't time the market. What I like to do is I look at a lot of different factors, and when I start seeing an actual turn in the market, a change of direction, you want to start changing your portfolio. If you're 80% stocks, 20% bonds, maybe you're going to 60-40 or 50-50. If you're in this for the long haul, it's not going to matter if you can put more money in, it helps. But just shifting your allocation, which is what we do, helps lessen the blow. I'm not an advocate of going to cash and trying to go to cash because that's market timing and you're going to be wrong. Maybe you get lucky on the upside, but then all of a sudden you don't buy back in and the market shoots up. There are people that never bought in from the market crash in 2009 that are still waiting.
So make it good stuff as always. We'll see about the jobs report next week. But in the meantime, tell people how they can get a hold of you.
You can always email me directly at Mickey, Mickey, at Envestim, Envestim.com, or go directly to the website, www.envestim.com.
Thanks as always, Mickey.
Thank you, David. See you next week.